Australia's household debt is putting us all at risk. Let's have a look. Hello everyone, Florian Heise here, and I hope you're having a good day today. It's Friday, so, 1:30 when I'm recording this. Most of you be ready for beer o'clock now in the office before you knock off for the weekend. Maybe that's one of the advantages of working from home, although I'm now drinking steins of coffee, not steins of beer or Bundy rum. Although now that I've mentioned that, I've put the idea in my head. Not sponsored, by the way, although I'd be happy to accept sponsorship from Bundy. I'm quite a fan of the dark and stormy, to be honest, and I never used to drink it. I'm going off on a story. It's Friday, you'll let me. I never used to drink it. Rachel did. She'd drink it all the time, and back when we just started living together, I'd run out of beer. And I go, oh, well, I might as well drink this rum stuff. And much to her disappointment, I fast developed quite a taste for it. And now whenever Rachel's pregnant, I'll go, oh, just, honey, grab us some rum. And she'll look at me really, really angry. Well, it's still good. Let me know in the comments what your favorite drink is for a Friday drinks in the office. Do they even have Friday drinks in the office now, or would it be too politically incorrect to do that type of thing? I think I remember I was talking to some clients and just saying, oh yeah, I've got a glass of whiskey here on a Friday. I'm having a great day. And they're all they were quite jealous on the phone. So, a global debt bomb threatens the Australian economy. Excessive debt was a key cause of the global financial crisis, but 11 years on, world debt is much higher, leading many analysts to warn another crisis is on the way, and Australia is far more vulnerable. Let's jump over to trading economics and have a look. This is their chart. What is it? Household debt to GDP. You can see right at the top, the data from December 2018 is Switzerland. And Australia is second. So come on, Australians, get out those credit cards, spend that tax return like it's free cash, and get us higher. Get us higher. You can do it. You could do it. Then there's Denmark, Netherlands, Canada, and Norway is just below 100%. Come on, Norway, you can do it. Where's Sweden? Sweden, oh yeah, there we go, Sweden. What about, let's see if I can find Germany. Whoa, 52.9%. What about our Kiwi cousins? 94%. Yeah, that's not looking really good, but we're right up there. We're right up there. Okay, so in 2008, the collapse of Lehman Brothers was the catalyst that froze global capital markets and caused the world's biggest financial catastrophe since the Great Depression. In the United States, unemployment hit 10% as the country plunged into the Great Recession. Eurozone economies were decimated, led by Greece, which effectively went to the wall. Global stock markets crashed, and in Australia, the Rudd government spent billions to keep the domestic economy afloat. Advised by the then Treasury Secretary, Dr. Ken Henry, the government's mantra was go hard, go early, and go households, with policies such as cash handouts. Does everyone remember the cash handouts? Rachel bought an imported sewing machine and actually has put it to very good use. Very good use, although not the promised shirts and suits for me. She has done a lot of repairs and is making a lot of clothes for the kids. So it's actually really handy. And her wedding dress. Yes, she made her own wedding dress. So I really should not complain in the slightest. It's definitely a lot cheaper. At the height of the GFC was debt. Far too much of it. A decade later, though, global debt is 50% higher. There's no doubt that is concerning, AMP Capital chief economist Shane Oliver told the ABC. If you go back through all recessions, crises, they tend to be associated with debt problems. According to the OECD, government debt is now a record high, 93 trillion, and could become unsustainable. Corporate debt, it noted, is even higher at 101 trillion. That's a combined total of nearly 200 trillion owed by governments and companies. That's okay, don't worry. It's just funny money. Just print it away. Print it away. It'll be fine. It'll be fine. Oh, what's that? You can't get inflation high enough to get rid of it? Oh, well. It has left the OECD worried. Should global economic growth and credit conditions continue to deteriorate, a new bout of financial stress could erupt, and the financial markets could become more vulnerable to episodes of contagion. It warned in its latest Global Business and Finance Outlook. Exactly what happened during the global financial crisis. So aggregated debt, however you slice or dice it, is at new all-time highs, with rates at new all-time lows. But rates can't go much lower, pointed out former ABN, AMRO and Morgan Stanley chief economist Gerard Minack. But, well, they can go negative. ECB has just cut their bank cash rate down to 0.5, negative 0.5. There you go. So if we were to get a recession, the extremely high level of debt would cause real problems for policymakers, and I think intensify the downturn. At the center of the world's debt mountain is the United States, where total public and private sector borrowings now top 33 trillion and rising. That's 17% of global debt concentrated in just one country, albeit the world's biggest economy. China's 1.6 trillion stake in the US government could be a problem. A potential flashpoint is the 1.6 trillion in US government bonds held by China. As US President Donald Trump ramps up his trade war, China could hit back by selling those bonds. Not that such a prospect appears to bother the president. If they didn't want to renew or re-up, as they say on Wall Street, that will be fine with us because we can refinance that very easily, Mr. Trump said last month. There's never been a time when more money has come to the country. That is optimism you would expect from the US government's salesman-in-chief, but others have a more cautious view. I like that. That is his title. You know, Trump is the salesman-in-chief. That's a brilliant name for him. I don't think he would mind it or even object to it, to be honest. I think he sees himself as that. That would certainly be a problem, because a huge sell down by a big owner of US government bonds would put upward pressure on US bond yields, making it more expensive for the US government to service its debt, warned AMP Capital's Shane Oliver. However, fellow economist Gerard Minack said the threat of a China sell-down of US government bonds is not as bad as it may seem at face value. I think if they really did see that as a major threat to the ongoing expansion, they would respond and print money to buy it, and they would reduce the impact on interest rates, he countered. It may weaken the US dollar, but I don't think US policymakers would mind that. So, I mean, there you go. It all seems a bit ludicrous, doesn't it? It really does. So, trading CDOs for CLOs, but the debt is still risky. A bigger concern is the surge in what is known as collateralized loan obligations, revitalizing memories of the collateralized debt obligations, CDOs, based on subprime home loans, which sparked the GFC. Collateralized debt obligations were created by banks, bundling up the home loans on their books and selling them as an investment vehicle. When the subprime loans underpinning the CDOs went bad, so did the CDOs, but the debts were magnified. Today, there are more than 900 billion of CLOs in the United States alone. These are similar in structure to CDOs, except that instead of being based on high-risk home loans, they're based on high-risk corporate debt. Okay, wow. Are we literally going to repeat the same thing that happened before? Yeah, of course we are. The high risk requires a high interest rate, and in a low interest rate environment, that has made CLOs extremely popular. It's the old Hemingway thing. How'd you go broke? Slow, and then very fast, warned Mr. Minack. We could just go straight to the very fast phase with corporate debt, given that we have so few conditions placed on most corporate debt instruments these days. Interesting. Australia vulnerable due to high household debts. In Australia, the big concern is household debt, which now stands around 120% of GDP and nearly 200% of household incomes. That ain't good. And as the housing market has bounced back in the last few months, individual loans are becoming even bigger. Bounced back in the last few months? I thought it was in the last month. Add that to what is happening overseas, and many are wondering if the world is slowly inching back to conditions like those that led to the global financial crisis. However, Shane Oliver is not yet unduly concerned. If you look at the overall picture, I don't think we have anything like the degree of gearing on the subprime mortgage debts that we saw going into the GFC, he said. It's hard to see a sort of bubble akin to the US housing bubble like we see prior to the GFC. Shane Oliver does think a good old-fashioned recession is coming, though. A recession with a ticking debt bomb and the lowest interest rates in history will make worse. Well, yes, they will make it worse. I mean, remember, let's just jump here to our indicators. And the biggest, what's the tool? The tool that that they use to help stimulate the economy, and the number one tool is interest rates declines. And we'll just jump back here. Here's the 2008 GFC. Look at that cut in the cash rate. Look at that cut in the cash rate. So they're building up, boom. What does that tell you? What are they going to have the capacity to move there? They're running out of fuel. They're running out of fuel. Do you think it's a big problem, guys? Let me know what you think in the comments. Like, share, and subscribe, and I'll see you all later today. Take care.